Well, good morning! On today's program, we're going to discuss the markets and who's really in control of them. Plus, we're going to get a little bit into emotions and what the future of investing is probably going to look like. Welcome to Central Florida's longest running radio show, Dollars and Cents. As you probably already noticed, we're not your host, Joel Garris. My name's Garret Fields. I'm a certified financial fiduciary with Nelson Financial Planning, and I'm sure you've heard me on the radio show before. My co-host is...
I'm Rob Field, also a certified financial fiduciary with Nelson Financial Planning.
And you're also a National Social Security
advisor. And a National Social Security advisor. You've probably heard some of our episodes where we've gone into detail about Social Security and how that works with your investments.
Yeah. Well, here at the office, we use a team-oriented approach, so it's important to make sure that everyone here has a different skill set. Rob is a specialist at Social Security. I'm a specialist at income planning. But with us being in the middle of tax season during this crazy time, we thought it's important to give Joel some time to spend with his family, make sure he has the opportunity to do that. So we decided to step in and give him a little bit of a break. But, you know, me and Rob were sitting in his office about a week ago or so, chatting, of course, after hours. Joel's still listening to the program. And we were talking about emotions in the market and how those have changed over time, especially in today's fast-paced society. It's almost like today people are expecting double-digit returns just based on what's happened over the market over the past couple of years. But what were the emotions like back a couple of years ago?
Well, years back, and I'm sharing some stories when I was a stockbroker with E.F. Hutton many years back. Expectation of performance, expectation of how quickly you might get information, expectation of how a market would perform was totally different than it is now. The numbers were lower. The time it took to get information and research took a lot longer, and people accepted that.
Yeah.
And this, of course, would be before we had the internet. That was not a resource that I had when I was a stockbroker. Cell phones were not around, and everything was done manually, so a lot of paperwork.
Yeah, so now if you ever want any type of information on any type of stock, it doesn't even have to be a stock anymore. ETF, mutual fund, anything. You can go on the internet and you can have whatever piece of information you want in about 30 seconds. So and it's going to be up to date. It could even be up to the minute up to date, not even to the end of the day. But what was, if you wanted some information on a particular stock or particular fund, how would you have gotten it back in the 2000s or back whenever you were in E.F. Hutton?
Well, before you could do research on the internet, and if I was a stockbroker and I wanted to build a position in some type of investment, I would have to buy a book and have it sent to me, or have a weekly publication sent to me, take a look at it, analyze the stocks or the mutual funds that I thought I wanted to utilize to present to our clients. Then I'd have to call each client on the phone, tell them a story, and then if that story got old and they wanted to think about it, then a week later the whole process would start again, get the same booklet, get the updated information. If they came to the point where they said, you know what, I would like to build a position in that stock, it was then writing down a piece of paper the information I wanted to send to my trading desk. Trading desk then calls New York. New York gets the trader on the floor who works for E.F. Hutton. E.F. Hutton trader goes to the floor, tries to place that position. If he can't place it at the price we wanted, then he comes back and says, not filled. Comes back to my office. They say, okay, you didn't get it at that price that you wanted. I call the client. Okay, we didn't get it at that price. We got to try another one. And the same cycle could be hours. So If you said, hey, I'd like to own this stock and I'm happy with it at 25, and then the market's making a move, I might call you back later on the day and go, it's 32. You didn't get it.
Wow. So first you'd have to get on Amazon. I'm sure you're an Amazon Prime member and order the book because, I'm sure that was around. No, just kidding. But that's a completely different process than now. I mean, today you can almost just go on your phone and you can almost buy any amount of shares that you want. You can even link your banking information to your account so you can transfer the money directly from there to your trading account. That's a completely different experience than having to call your broker and going through that whole process. How long would that process take just to get, one or two shares of a company?
If you ended up trying to get at a certain price, you might find that it took you all day long to fill the position you wanted of the stock.
So there was no day trading. You couldn't.
No, day trading had not. Day trading came around with the internet. The thought of being able to buy and sell a stock multiple times during the day just was inconceivable.
Yeah,
and you were truly putting a whole lot of time and effort into finding the stock or the investment you wanted, decide you're going to take a position. It could take you days to get all of the shares that you wanted, especially if you're trying to get it at a certain price. And sometimes we just lose interest and say, you know what, it's not our day to get that stock, pick something else.
Wow.
Very slow process.
And that just comes back to the emotional piece of it, right? Because the faster you can do something and the more connected you are to something, obviously the more emotional you're going to be towards it. So if you were only getting information, how often would these books come out that gave you information on these stocks? Is that every day, every week?
These books were available on a weekly basis at thousands of dollars a month to get it. And you have to think about it, by the time I get it, it's been published. The information is probably a week old. So I'm always working off of information that's 4, 5, 6 days old.
Wow. So you can't even, today you can get numbers at the beginning of the day and then you can get numbers at the end of the day and they've been completely updated. So back then you had to kind of go through a book and get numbers every week, and those numbers were a week old. So that's just crazy how much things have changed.
You and I were talking about how we can take this cell phone and have a conversation and within 10 seconds buy that investment that we were just discussing.
Oh yeah.
At the price that we were discussing it at that point.
We could have day traded multiple times just during this conversation that we're having. So that's just impressive as to how much things have changed, and obviously emotions have changed with it, because now there's such a higher level of involvement, and now there's so much more information being thrown at you constantly about what's going on. But
which is beneficial, because I think what happens now is the investor today never had to experience that delay in purchasing. So they know that if they have an interest in something, they can grab it pretty quickly, be it a mutual fund, a stock, a bond, whatever. It's available momentarily. They can grab it. Costs have gone down. There's different ways they can get it. They can even bypass a broker and just simply place a trade themselves. And you and I have discussed how in the past it just wasn't that way. So today's investor is a little spoiled. They're expecting to be able to call or get online and grab something immediately. Yeah. And a delay is not something that they want to experience or that they even think they should.
Yeah, and it's just amazing how quickly things have moved, But the other thing that really drives emotion is volatility.
Very much.
And one of the big things that drives emotions, and whenever you can spin this volatility as particularly high, the media love to get involved. And we've talked about it on the radio show, where fear has a 3 times stronger reaction than positive news. So if they can push this fear of high level of volatility, they're going to run with it, because it's going to constantly keep you hooked.
Right. In today's age, not only is it faster to be able to invest into investments, but the information thrown at the investor is ridiculously quick. Between a podcast, a radio show, a television show, internet, things pop up. I'll have on my phone throughout the day, Market Watch popping up this. It's just coming at you so quick.
Oh yeah, you have Apple Finance, Yahoo Finance, Market Watch. You have multiple TV shows dedicated to strictly the market. Every single publication is gonna talk about it in some form. So yeah, that's just gonna drive higher levels of market. And whenever we come back, we'll take a look at some of these numbers and see what they're actually pushing.
Excellent. All right, and we are back. This is Rob Field, Nelson Financial Planning. Sitting next to me, Garret Fields, Nelson Financial Planning.
Both certified financial fiduciaries. And we were talking about emotions, and we were comparing what today is like back to whenever you were at E.F. Hutton.
Correct. I was going to just tell a little bit more about my past there. My days with E.F. Hutton as a stockbroker were in the mid-'80s, going into the '90s. And it was a lot of fun. You see it in the movies. There was a lot of excitement. There was a lot of energy, a lot of communication on the phone, trying to get some things going. And at that point, as I'd mentioned, the internet was not really a resource. Everything was done manually, be it place an order, do some research. Phone calls, it was harder to reach my clients just because they didn't have a cell phone at that point. So if they're at work, they're not taking the call. If they're at home, they're not at home. They cannot take a call. So sometimes you would have to catch somebody after hours. So now you're trying to explain to them the value of something that you're presenting, and you can't even actually give it to them at that moment. Whereas we know today, there is some availability 24 hours to get. So from the 80s until here in 2020, 2022, massive changes.
Oh yeah, and then I mean, email, even just with email. Well, and whenever we come back, we wanted to talk about some of the numbers and some of the volatility numbers that have been happening. That the media could possibly push just to drive a little bit more fear. I know, Rob. I know you looked up some of those numbers. What kind of were those numbers? Recently over the last 12 years or so?
Yeah, I'm going to share that momentarily.
Okay.
We had talked about rates of return and what people are expecting. And so back when I was at E.F. Hutton, if you were getting 6, 7, 8% fairly consistently, those numbers were presentable. People could go with that. And then as we know, we've seen the expectations are for higher returns and quicker returns. And not just, I'm averaging over 5 years a great number, but they want over the next month to get some fantastic return. And part of the volatility that we've seen today is about managing their expectations. What really is reasonable today? And I think what throws people for a loop is their buddy who bought the one stock at the right time and 2 days later tripled their money. And that's just not how it always works. But that story circulates to the point where clients are like, well, I think I should be able to get that kind of a return in a very short period of time.
Right. Now with media, or now with the internet and social media, people are constantly posting about their big wins. Now, of course, they never post about their big losses, but
Right.
They only post about their big wins. And people see that, and then they want to get that same level of return. And that's almost what they're expecting now.
Right. But we were talking about the S&P, what it's done over the last year as far as performance numbers in different segments. And volatility is exactly what we're seeing. Over the last 2 weeks, the S&P has been up 2.7%. It's a pretty good number for a 2-week period. Mm-hmm. But even better, over the last 2 weeks, that market is up 11%. Now, I hear everybody tell me this is the worst market they've ever seen. Everybody should be out. 11%, that sounds like a good argument for it.
Over 2 weeks, absolutely.
But then the last month, 30 days, we're up about 7.6%. So 11, now we're down to 7. What could have caused that? Volatility? Sure. Because since the beginning of the year until now, the market's actually down 3%. So that 11 that seems very attractive is a short term. 3% over the last 3 months is a little more realistic of what this market's doing. Now, we know based on the Ukraine-Russian war, it affected the market. We know that the fear of COVID still lingers. That's affected the market. And then we know that interest rates are going to go up numerous times this coming year. And people have a tendency to feel like, if interest rates are going to go up, stock prices are going to go down. And if interest rates are going to go up, I'm getting out of stocks and I'm going to go over to bonds. We're going to talk about interest rates later on, and you and I realize that's still not an attractive option. Mm-hmm. But what's funny is over the last 12 months, the market is actually up 17%. So even though down 3 year to date, and I've got only some 2s, I got some 11s, the dust settles last 12 months, 17%. Very few people know that because they're assuming based on their emotions and their experience that the market is just tanking. It's not. It's volatile and it's a roller coaster. And it may be uncomfortable, but the long-term results are there.
Wow. So you're telling me over the last 12 months, the market's up 17%. Last 3 months, market's down 3.2. And last 2 weeks, it's up 11.
Right.
That's some extreme levels of volatility. But, we actually have a volatility index called the VIX.
Correct.
And even with those insane numbers that we're saying, and even with that high level of volatility that it sounds like, the VIX is still sitting around 20. Well, back in 2008, it hit 80. Back in 2020, during the COVID crash, it was up to almost 70. So even though we're seeing high levels of volatility, 17% in the 12 months, down 3.2% in 3 months, and up 11% in 2 weeks, we're still, this is just a normal, healthy level of volatility. I mean, the market does have these occasional pullbacks, and again, that's healthy.
The confidence level amongst investors right now is very strong.
Mm-hmm.
As much as there are stories and things on TV and information that makes it look like the market is very scary and you should get out, that's somebody trying to sell a book. They want you to watch their show. They think if they put the fear in you, and then in return, you must listen to them and do what they say because they can alleviate your fear. That's their goal. They're just selling you something.
Well, and what's amazing is whenever you back out and look at the long-term numbers, you don't look short-term anymore. Everything, the doom and gloom kind of starts to go away. The reality is that going back to 1946, we pulled from some data from CNBC. Going back to 1946, there's really only been 3 declines of 40% or more. And you say 40%, okay, that's a really big number. Well, what about maybe 20%? Well, there's really only been 9 declines of 20 to 40% over the last 75 years. So there's really only been 12 declines of 20% or more over the last 75 years. I mean, that's pretty good numbers. And then, to look at the flip side, the positive side of it, the reality is that 75% of the time the market goes up. 3/4 of the time the market's positive. And of that 75%, if the market's positive, 57% of the time the market's producing double-digit numbers, according to CNBC. And then even if you take it one step farther and you take a look at, okay, well, I'm really worried about a negative return. We know the market's up 75% of the time. What happens if it's a really big decline? Well, that doesn't happen nearly as often. Only 13% of the time is the market down 10% or more over an annual calendar year. And a perfect example of that is actually 2020. We were just talking about that in your office. 2020, the market was down 33% at the beginning of the year. But at the end of the year, it was up 15%. I mean, you had to go through a high level of volatility, but once you went through that, you were up 15% for the year. That's phenomenal.
It is. It just makes the case that you've got to, as a longer-term investor, you've got to think as a longer-term investment objective. If you are trying to simply beat the market in a short period of time, it's really not a long-term objective. And there's a lot of conflict. People want to try to get something short-term, but they still want that long-term need. You point out a couple things that are very interesting. How often does the market really go up? 75% of the time. Perception is that the market is volatile and that it's down more than it's up, and that you have to pick and choose to really be successful, and that's not the case. You can buy and hold through a high-quality mutual fund that's got high-quality stocks, and you actually get some really fantastic returns. The other point you mentioned, I thought was kind of interesting, was the number of times the market is greater than 10% in its return. It's 57%. More than half the time the market is giving you a very healthy return. But the only way to get that, and we've said this before, is you got to be in the market at all times. You cannot time the market. The only way to overcome volatility, and volatility can be your friend if you're a long-term investor and you buy and hold quality.
Yeah, I mean, as we said before, I mean, up 11% in 2 weeks, but down 3.2% over the last 3 months, but up 17% over the last year. That's a big level of volatility right there. But going through all that, again, over the last 12 months, you're still up 17%. So, long term is key. And we even preach this at the office. I mean, clients will come to us and say, hey, I have some money, I'm going to need it in a year. What do I do with it? And the answer is, unfortunately, I know it's hard, especially in high inflationary environments, but the answer is keep it in your bank. In the short term, over a 1-year time frame, the market's just too volatile to have that money invested. But we're getting ready to take a break. This is Dollars and Cents. We'll be back with you here shortly. Welcome back to Dollars and Cents. Again, this is Garret Fields, a certified financial fiduciary with Nelson Financial Planning, and my co-host today,
Rob Field with Nelson Financial Planning.
So on this segment, we want to talk about, what drives the markets and what really are the markets. You hear a lot of times people say, well, the market did this or the market did that. What are they really talking about, and what really moves those markets? First thing we kind of want to establish is most of the time whenever people are saying, oh, the market did this, the market did that, they're primarily talking about either the S&P 500 or the Dow Jones.
Correct. Two indexes that sort of indicate market movement. And again, we point that it is an index and it does indicate market movement. It's not an entity in itself. So we've talked about the Dow Jones numerous years. That's the one that the index has been out for the longest. 30 companies, sort of a cross-breed reference of what is going on in America. Each company has a little different, unique style. So when you look at those 30, it's an indicator. How they perform as a basket kind of gives us an idea what the economy might be doing. A more accurate, or I guess a more diverse way to look at it would be the S&P 500, right?
Yeah, and I think that you're absolutely right whenever you say indicator. This is an indicator of what people are thinking and what people are doing. This market, the S&P 500 or the Dow, they don't just move on a whim. Every time they move, that's a movement, that's someone has done something to move the market in that particular way. Because, as we know, both of these indexes, they're just made up of individual stocks.
Correct. And the stocks are simply being bought and sold. And then if more people are buying stocks than selling, typically you see the index go up. And if there's a number of people who are selling stocks instead of not buying, you see that index go down. And it's not always the fact that they think something's wrong with the market, and so then they're selling. It could be their needs of profits, could be they're heading somewhere else. It's just an indicator of what has happened in the past. It's not necessarily going to try to project what's going to happen in the future.
Right. It's an indication of what's going on now. And anytime the market moves, that's a movement because someone else has already done something. So,
right.
As we were talking about these, especially the S&P 500, the way that that's made up is they just take the market cap of the largest 500 companies in the U.S. and they compile them into the S&P 500. So it really is just a bunch of individual stocks. And it's what ends up happening, and how these indexes end up moving is an individual will buy or sell a stock. That stock price will fluctuate, and then depending on the weight that that stock has in that index, the index is going to fluctuate accordingly.
True. And we bring up the fact that that the S&P and the Dow Jones is an indicator or an index because we get so many calls from people saying, oh, the market is doing bad. Something's wrong with the market. I'm looking at the S&P and I don't understand why it's doing what it's doing. And it's really the investor themselves that drives it. It's a portfolio manager, an investor, someone who buys or sells the stocks. It's just simply telling us what has already happened. So there's really nothing wrong with the market. You don't have to fear the market. It is simply telling you what's going on. And again, if we talk about long-term investing, the market's your friend. If we talk about volatility, the market's your friend.
So what are some things that kind of drive people to either buy or sell these stocks? Most in any of our clients that came to our educational event, this is going to be a little bit of a recap for you. But the main thing that drives stock prices is PE ratio.
Sure.
And so we want to get into a little bit as to what that is. So PE ratio is price over earnings. And the way that you get that, starting with the earnings portion, is a company has a set level of earnings that it has over a quarter, over a year, and you take that earnings and you divide it by how many shares are outstanding. And is what that says is that's how much earnings each investor is entitled to per share that they own. And then you divide that by the price. The price is how much you have to pay to get that individual earning. If that's a good price, then that stock is probably going to go up. If that's a bad price, that stock is probably going to go down. But that's a good way to compare multiple stocks to each other.
True. And you can use that PE ratio to compare different types of stocks. If you have a large company with large earnings, you're probably not going to have a huge PE because the earnings are strong and the price is in a good position. If you see a PE that's extremely high, but it's a small company, low earnings, but that company has a great story and we think it's going to go up, then you might see that have a high PE. And then you don't want to compare a small cap company with a large cap company and then on PEs. You want the PE to be referenced to the type of stock it is. And these are the things that a portfolio manager inside of a mutual fund is looking at. This is one of the things they know to show quality, dividends, and things like that, and can help in their selection as they build a stock portfolio.
Absolutely. And PEs are a little bit of the PEs are higher right now, but yeah, that's one of the main things that drives a decision to buy a stock. And like I said, if you were at our educational meeting, you kind of already got this recap. But yeah, that's one of the big things that determine if people are going to purchase or sell a stock is the PE ratio.
Sure, and then that kind of gives you an idea of what type of company is it. What are their earnings? Are their earnings high? Are their earnings low? What's acceptable? Small companies that are still in a growth phase, earnings might be low, but potential's high. Price goes up, and that's okay. Dividends will come into play at some point. If you look at a stock and you're thinking you're looking at the PE, but you want to know what kind of dividends it's paying. Is it giving you a yield? That'll affect your decision. And then if you have a company and it has some earnings and it's paying those out as a dividend, that could affect the PE also.
Absolutely.
Something to think about in stock selection, and our portfolio managers use that in their day-to-day activity.
Absolutely, especially as you start to look at that compared to other alternative investments like bonds. Some of those dividends that are paying out look very attractive, especially whenever you compare it to what bonds are paying out right now.
Sure.
You take a look at, there are some companies, a little rare, but some companies that pay out 7% dividend. Whenever you compare that to a 10-year treasury that pays out 2%, that's 3.5 times larger. Now you got to deal with the volatility that the stock has versus the bond, but the bond has some drawbacks as well.
Sure, interest rates is something you and I were going to hit on later on in the show, but as it changes, again, we go back to the perception. If interest rates are going up, the investor might feel like, oh, then this is the time to get into bonds. And as you and I know, that interest rates are going to change dramatically, and we'll go into that in more detail. And as each time there is an increase in the interest rates, that means whatever bonds are out there, even one you might buy today at a slightly higher yield than last year, is subjected to downward movement in the price itself.
Correct. And the Fed is already hinting at they're going to do 6 interest rate hikes this year. So, bonds, and we've talked about this before, but bonds are just a tough place to be in, especially if you're in those longer term bonds.
Right. We're talking about what's driving the market itself. And we know it's the investor, and we know that it's perception and things like that. So, again, we emphasize on those indexes. When people complain about them, they are the ones who are driving the index.
Right.
So when we say who's in charge, the investor's in charge. The investor has the option of picking and choosing what mutual fund they want, how much they would like to get of it, and their activity and their demand is what really gets that stock market moving, and the index is changing.
Right. So if a group of individuals would decide to sell a particular stock or something like that, that's going to drive down the index. So whenever people are wondering, hey, why is the index dropping? Why is the market dropping? That's just because individual investors have decided to either sell shares that are inside that index or sell the index itself.
Right. We talk about portfolios and we talk about the supply and demand. It's all built on what they think their investment objective is. And our goal is to help them understand what their long-term investment objective is, and then have them make their decisions based on that long-term goal. We hear all the time, it's the standard desire as an investor would be to, I want very low risk, but I want extremely high returns. Or I want the same thing my neighbor had. He bought a stock or he bought an investment and it doubled in a short period of time. I want that. And it's not, that perception that the ability to get that kind of return easily is not accurate.
No.
There's just no way you're going to consistently double, triple your money in a short period of time. Buy and hold is the quality. Coming up with your investment objective, building that portfolio to meet the long-term investment objectives works out well.
And of course, that loops back to what we were saying earlier is, they might post a lot of their booms, but no one ever posts about their losses, their massive losses.
Right. And you and I saw that over time, the buy and hold scenario always works best for the long-term investor.
Absolutely. Well, we'll be back after this short break with Dollars and Cents. Welcome back to Dollars and Cents. My name is Garret Fields. I'm a certified financial fiduciary and my co-host.
I'm Rob Field, certified financial fiduciary, National Social Security advisor here at Nelson Financial Planning.
Absolutely. So we just wanted to continue that thought of interest rates and kind of compare some, how that's going to change the financial field. So, one of the things that we look at and for a short-term investment is CDs. And interest rates have a big impact on CDs and what they're currently paying. Right now, CDs are currently paying around 1 or 2%, right? And, is that a good investment, or is that something that you should even really consider? Are there other investments that might be better that serve the same goal? So the first thing that we wanted to compare CDs to was a savings account. Savings accounts are paying virtually nothing. CDs are paying 1. Right off the bat, looking at that, CDs sound like a much better deal.
I mean, you could make the argument that for your short-term money, that your savings account at pretty close to 0 is not going to give you much of a return. And if you're sitting on some money and it's not going to transition over into a long-term investment, you're going to need that money within the next year, you could make an argument that a 6-month CD pays a little bit more than your savings rate at the bank, and so you could lock that in. Again, as a long-term investment, it's going to do nothing for you other than just park your money for a short period of time.
Yeah, and the problem though is now your money's locked up. I mean you said it perfectly. It's locked up. So if you want access to that money, there's a penalty, which essentially wipes out all the growth that you've had on it. So you're trading a 1% rate of return for not having access to your money. You're deciding to give up liquidity essentially for a 1% rate of return. And I'm just not sure that a 1% rate of return is really worth that, not having no liquidity.
Correct. And then mix in inflation, right?
Right.
If we're talking about interest rates currently, or even if interest rates go up a little bit more, inflation is still 6, 7, much higher, depending on what we look at. So a CD, and then you pay taxes, and then you look at inflation, and then let's say you have to break the CD for an early withdrawal penalty, you're back to square one. It wasn't worth the effort.
Yeah, I mean, if inflation is going to be 7% and you're locking in to a 1 or 2% return over a 1-year period, you're essentially guaranteeing yourself a real loss of a 4 to 6%. I mean that's, yeah, granted it's not the 7 if it's sat in your bank account. You're also giving up liquidity for that, but you're locking into something that's pretty much guaranteeing you a 5 to 6 real rate of return loss.
Correct. Right off the bat, inflation is eating it up, and you're getting no growth at all.
Right, and then you compare it to, and it all depends on what your goals are, but then if that's your long-term goals, then you compare it to other long-term investments like equities, and it just it just starts to not make as much sense.
Right. I mean, we're in a position right now where rates needed to go up to slow down inflation. No argument there. And as you had mentioned, there's probably 6 rate hikes coming up in the next year or so. So interest rates are going to go up. But they're so low now, and they're not going to go up so fast, because then we would jump into a recession. So even though we know rates are going to go up, it's not going to present an opportunity that you're going to really want to take advantage of as a long-term investor. Now, the flip side would be housing. We've talked about that before. If you're going to go out and get a mortgage, even the slightest increase in a mortgage rate on a 30-year mortgage can add, as we said, about 17% to your total monthly cost, which could be a couple extra $100. That hits close to home. I understand the concern there, and we'll see that. But interest rates rising as an alternative investment to what you're currently doing is really not going to be a dramatic change. You're not going to suddenly change your portfolio over to CDs or bonds as a long-term investor.
No, and I might put you a little bit on the spot here, but if we do 6 interest rate hikes, is that going to make CDs any more attractive? I mean, are people going to flock to CDs after 6 hikes?
I mean, even after 6 hikes, we can look at the interest rate at where we would be on a CD and still compare it to inflation. Because, I mean, we're not going to suddenly 6 months from now have a couple of interest rate hikes and people go, oh, inflation's dropped from 6 to 1. We're going to hover in that range for a while, because I think we've just seen different things in the economy that are driving that up. So the interest rate hikes are to help slow it down, but it won't be an overnight sensation. And I don't think a year from now you're going to see a CD rate or a savings rate at the bank that's suddenly going to be so attractive that you would get out of an equity that averages pretty good returns over multiple years.
Yeah, I would agree. Even with the 6 interest rate hikes, let's say you get up to maybe 3, maybe 3.5 on a CD. I mean, that's still, with interest rates running at 7, you're still guaranteed to be locked in at a loss. And same thing with housing. These interest rate hikes are going to affect housing. We talked about on the program last time that the interest rate that happened in March increased payments by 17%. So that's definitely hitting close to home. But the crazy thing is if you still look at it as to what mortgage rates are comparatively over the last 50 or 70 years, we're still at almost an all-time low. I mean, so is the housing market, are they going to slow down buying houses? I don't think so, just because of how low interest rates still are.
Very much so. And that led us back, we've talked about stocks that pay dividends, and those numbers are still very competitive. So if, as a longer term investor, if you're looking at a high quality stock or a mutual fund made up of high quality stocks that has a dividend yield, that dividend yield is still more competitive than the CD rates. And for long-term growth, keeping up with inflation, have a dividend yield, high quality company with a good story, it's still going to be your best bet for long-term investing.
And the one other thing that we want to talk about before we wrap up the radio show is how young investors have kind of changed the market. During COVID, everyone was sitting at home, everyone was bored, everyone was restless, and then on top of that, large stimulus came out. not only with the unemployment, getting around $4,000 a week, but also just with the 3 stimulus checks that came out. And this really put some young people in a situation where they finally had the privilege to be a little bit more riskier with some of their investments. We saw a massive rise in sports betting. We saw a rise of young investors getting involved in the market, which is awesome. And that, that did come with some consequences. A lot of these young investors lost a good amount of money. And that's okay, because the trade-off for that is even though they lost a good amount of money, they traded that for experience. I mean, these young investors, even though they might have had, even though they might have lost some money, they still got involved at 20 years old, or possibly even younger, and that's a really good thing. So it's interesting to see what that's going to lead into.
I agree. Those stimulus checks came out, and they were very helpful for many people that were struggling with what COVID had done to them and their employment and things like that. But a lot of people got the stimulus checks, and it seemed like a bonus to them. Mm-hmm. And at the same time, the market was having some great movement. They viewed it as the free money. They said, if there was ever time for me to invest or play the market, or not necessarily gamble, but try to do a little intro into the markets, then this was the time to do it with the free money. And as you mentioned, even if they were unsuccessful with that endeavor, they learned from it. The next time they go in to make a trade, they'll be a little more savvy.
All right. And the crazy part about that is the level of trading that they had access to. I mean, you go on Robinhood and you can put in calls, you can put in options, you can go on margin. I mean, these are very advanced forms of investing that some people just had access to with $1,000+ So yeah, it's just interesting to see how these young investors are going to push the market forward going forward.
Yeah, I think what we noticed today is that this market keeps changing. You got to stay on top of it. Mm-hmm. Always reach an investment professional if you want to get some more advice.
Absolutely. Well, hope you guys have a wonderful rest of your day. We're wrapping up the show. This is Dollars and Cents. See you next week.